Hello everyone. In the series of the profitability analysis, the last video we have seen is about the return on equity. We discussed what is the return on equity, its formula, and as a financial analyst or CFO, or if you are a potential investor, right, how you can understand the ROE, analyze and do the interpretation. Okay. During the discussion, we have understood that ROE actually, since it is based on the last element of the profitability statement, right, it may not give you the full understanding of the profitability of the company. You can understand how much equity shareholders are earning, okay, that you can understand, but whether they are earning due to good operations of a company, whether it's due to operational efficiency, or whether they are getting the good return on equity just because the company is utilizing more debt, right, that will not be able to understand just looking at the ROE formula. There was a limitation. So in order to remove that limitations, yeah, so there was an analysis done. There's a model developed which is called DuPont model, right? The DuPont model actually it has two like three-step model or the five-step model. In this video, we are going to discuss about the three-step model, which will be very useful if you have to analyze the ROE properly, right? So let's understand what's the DuPont model. So in the last video, as you've seen the formula of ROE. So ROE formula was PAT minus preference dividend divided by equity shareholders fund, right? That was the formula for ROE. So DuPont model, what exactly does? It dissect that formula. Okay, dissect that formula. So ROE has been dissected into three formulas, different formulas. One is net profit margin. The second one is asset turnover. And third is equity multiplier. So dissect the return on equity formula into three to give us a better understanding. Now what understanding? Let's go into the detail. So net profit margin, basically what's the formula? So its formula is net income divided by revenue from operation. You can call it sales or revenue from operation. Say net income divided by revenue from operation. Now what is net income? Net income is nothing but PAT. Okay, profit after tax, the last element in the profitability statement. But here, since we are talking about the return on equity, so just in case if there are any preference shares in the balance sheet of the company, and if the company has to give any dividend, so from the PAT you will deduct the preference dividend. So PAT minus preference dividend, that will be your net income, right? PAT minus preference dividend, that will be your net income divided by sales or revenue from operation. So that will be your net profit margin. Now what do you understand from this, or what does this net profit margin show? So net profit margin is showing that from the revenue or sales, how much profit company is generating. From the sales, how much profit company is generating. Okay, from the sales, how much profit the company is generating. So basically it is showing the operating efficiency. It is showing the operating efficiency of the company, like how company is operating in order to generate more profit from its sales. Okay, how the company is operating in order to get more profit from its sales, right? So it shows the operating efficiency. This is about the net profit margin. Yeah, now let's go to the asset turnover. What is asset turnover and what does it show? Asset turnover formula is revenue from operation, like you can call it again sales or revenue from operation. Just say revenue from operation. Okay, revenue from operations divided by total asset. Revenue from operation divided by total asset. It means what exactly is showing? It's showing how company is utilizing the asset, how well company is utilizing their asset. Like by utilizing their asset, how much revenue they are generating, how efficiently they are utilizing their asset to get more revenue, how efficiently they are utilizing their asset to get more revenue. So it shows you the asset efficiency. How effectively they are utilizing their asset to generate more revenue. Okay, This is showing operating efficiency, this is showing asset efficiency. Now equity multiplier. Equity multiplier formula is total asset divided by equity shareholders fund. Total asset divided by equity shareholders fund. This equity multiplier actually what is showing, how company is financing its asset. How company is financing its asset. How company is financing its asset. Okay, so it is helping you to identify your financial leverage. It shows the financial leverage. So you can draw multiple conclusions. One is like how company is financing its asset, or how much company using its debt to finance its asset. So just to tell you in simple example, let's say company's total asset is 100, okay, and company's equity share capital is also 100. It means whatever the asset company is having, that all are financed by the equity shares, right? All are financed by the equity shares. There is no portion of debt, right? That's what it'll say. But if you put, okay, total asset are 100, but equity share capital is 20, it means in order to get this 100 asset, they have just $20 of capital. How rest are coming? Rest is coming from debt. So basically equity multiplier helps you identify how company's total assets are financed, okay, or how much company is utilizing its debt to finance its asset. You can draw both the conclusion from that. Yeah, so it tells you about the financial leverage, or how much company utilizing its debt in order to finance the asset. You can identify using that. So that's the equity multiplier. So if you look at the formula, right, so once you multiply this, you will get your return on equity. How? Here you have revenue from operation in denominator, and the same is there in the numerator. So this deducted, this total asset here, total asset here, knocked off. Basically you have the same formula, PAT divided by equity shareholder. It's just that the formula is same overall, but since we are dissecting it, and by dissecting we are understanding how the company is operating efficiency, how is company's asset efficiency, and how the debt is being utilized, what's the financial leverage. So since we get into the detail of all these three, it helps us to identify, to know if the company's ROE is more, then why it is more. Is it because the company is operating very well, that's why it is good, or it is just that company is having more debt or utilizing more of a debt, right? Is it because of that? So this DuPont model is basically helping us in dissecting the return on equity, so that we can analyze that if ROE is more, okay, why it is more. Is it because of the company is operating very well, or is it because of like just the financial leverage, like company is utilizing more debt to earn the to increase the ROE, right? Now I have written an example here. Let's understand using this example how this different element help us to analyze the return on equity in detail. Yeah, so this is a company A, company B. I have written the various parameter, net profit, sales, and everything. So if I have to calculate the return on equity, right, what's the formula? Net profit is 120 divided by equity share capital 300,000, right? So basically it is 40%. Return on equity is 40% here. In this case it is 100,000, and equity share capital is 200,000. So basically it's 50%. So here ROE is 50%, here ROE is 40%. So if you just look at the ROE, you will understand that company B looks better, right? Company B is looking better because it is having the more return on equity, right? So on top of the things, like you can take that analysis, right? But now with the DuPont model, we'll go into detail and understand if the ROE is more, why it is more. If this company is having ROE is less, why it is less, and then we'll take a call which company is more suitable for your investment purposes, right, or for your analysis purposes. So let's see the net profit margin. So company A, company B, net profit 120,000, okay, and sale or revenue from operation is 10 lakhs or 1 million, right? So this is 12%. So company's net profit margin is 10%, 12%. Here it is 100,000, and its sales is 1.2 million, like 12 lakhs. Here its net profit margin is approximate 8.33%. So looking at this, what we understand, that company A's profit margin, like net profit margin is more. Company A's net profit margin is more. Company B's is comparatively the net profit margin is less. It means company A is operating more efficiently. Company A is operating more efficiently than the company B. Okay, that's one thing. But still, company A's ROE is less. Okay, now let's understand the second formula, asset turnover. So asset, it is having 500,000 and total first is revenue from operation. So revenue from operation is 10 lakhs, like 1 million, and asset is 500,000. So this is 2. Now what about the company B? Company B sale is 12 lakhs, 1.2 million, and its total asset is 6 lakhs, 600,000. Right, again it's 2. So asset turnover is same. This is also 2, this is also 2. It means both companies are actually utilizing their asset more or less in the same way to generate the revenue. So they are utilizing their asset correctly, or they are utilizing in the same way to generate the revenue. So there is no difference here. Okay, now let's go to the third one, equity multiplier. Equity multiplier is the total asset. So total asset is here 500,000, and total asset for the next one is 600,000, right? But what's the equity? Equity for first company is 300,000, and here it's 200,000. So here this is 3. The equity multiplier is 3, and in this case, for the case of company A, it's 1.67. 1.67. So equity multiplier for company A is 1.67. Equity multiplier for company B is 3. It means, what do you understand from this? It means here company is financing more of the assets. In case of company A, company is financing more of the asset from the equity. More asset is being financed from equity, and only like some portion, like only 200,000 is financed by debt. Here company is financing, in the case of company B, company is financing more assets from the debt, because just equity capital is 200,000, but they have asset of 600,000. It means they are financing their assets more from the debt. It means their financial leverage is higher, leverage is higher, or their debt component is higher. Now what happens, like if you just multiply this, right, 12 multiplied by 2, so 12 multiplied by 2 multiplied by 1.67, you will basically get the ROE, which is 40%. Even in this case also, like when you just do a multiplication, 8.33 multiplied by 2 multiplied by 3, you will just get the ROE. So now what conclusion you can draw, right? First thing is, we know that the company A is operating more efficiently. The operating efficiency is more. It is earning more profit on its sales than the company B. Asset, no difference. Both are utilizing very well. The third is the equity. It means the company B is more financed by the debt, than the company A. So due to that, although the company A is earning more profit in terms of efficiency, like the profitability percentage, but ROE is low because they are less financed by the debt, whereas company B, their operating profit is less, their operating efficiency or the net profit margin is less, but since they are more financed by the debt and less by equity, that's why their overall ROE is more, right? So this is basically a high risk company, because their profitability margin is less, operating margin or operating efficiency is less, but since they are having more debt for the finance purposes, less equity, that's their ROE is more, but still it's a high risk, because if there are any negative impact on the earnings of the company, then it will be a problem for this company, because they are having higher debt. Whereas company A, although its return on equity is less, but their operating efficiency is more, and they are less leverage, less debt. So in longer run, this looks to be a better company because they have less debt and the profit margin are also higher, right? So this way, this DuPont analysis help you to analyze. Okay, so on the top you will see ROE is more for company B, but when you dissect and analyze it in detail, then you would see like which company is overall better. This company B, is able to utilize its debt to generate more ROE for the company. So this is how the companies actually leverage, utilize that leverage, right? This is again a point to discuss, which I'll take up in the next video, right? How the company utilize debt to manage their ROE. Again, this is for other discussion, but what I want to tell in this video, so this model is really helpful to dissect the ROE and to understand which company is good and which company is bad in the various aspect, right? So that you can take a prudent call about your investment, about your analysis, right? So I hope this video using like through this video you must be clear about ROE and the DuPont model and how it will help you in analyzing the ROE in detail. So if you guys are like continuously watching my video, or if you like this video, so please like and subscribe my channel. And also please do leave the comments, how do you like, whether you like my video or whether you want me to do any improvement, or in case you have any questions or comments, please put into the comment section, and I'll be posting more videos about this, and see you in the next video. Bye bye.